Stocks continue to bounce, following through on Friday's nice rally with another 1+% day today. That's been a good sign for stocks in the past. We'll talk today about whether it's going to be a good sign for us going forward, how long we can expect this bounce to last, not only in the short term, and where there might be some resistance and what we might see as early as tomorrow, as well as the intermediate term heading into the next few months into what seasonally is a pretty good bullish time of year. Once we get through September and early October, from mid-October on tends to be pretty bullish. So, what do we expect to see with this bounce that we're getting? Has it changed our outlook? Has it changed the posture? So we're going to break that down. We're going to talk about we're going to have a discussion on yield curve inversions and the difference that this one is compared to others, with a big glaring difference that hasn't been talked about too much. And then finally, our trade idea of the day is on a stock that's kind of leading this rebound and how we might be able to trade it going forward based on our market posture as well. So let's go ahead and get started. Today is Monday, August the 19th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the market forecast indicator on the S&P 500 like we always do. And you can see with the turn up the last 2 days, the intermediate line has turned back up itself. Again, it's not dark green shading there, right? Which what it takes for it to get above, it needs to get above the 50th percentile for that to happen. The near-term line made its way back into the upper reversal zone, and that's actually a really good sign. Again, when you're bullish, it gets up in the reversal zone. When you're bearish, it gets in the lower reversal zone. So right now we're kind of doing a little bit of both. There's some volatility, obviously, in the markets. But, again, the posture has been bearish. So the concern would be that we would not peak, and that would help confirm the continuation of that bearish posture. So the fact that we're not getting that, we're popping back up, is a good sign. Obviously, it's led to this turn higher in the intermediate line back to the upside. The momentum line is right near the midpoint of the chart. Obviously, it's we're kind of stuck in the middle of a range here. Well, I guess depending upon where we're at the top end of a short-term range, kind of stuck in the middle of this little range, midpoint of the last 26 days or so. If you take a look at the Dow Jones Industrial Average and look at its market forecast, same thing. You have this weak bullish posture, about as weak as you can get, right? Because it's really close to 20, but it did not get into the reversal zone. The near-term line, again, getting into the upper reversal zone, good sign. Same thing with the NASDAQ, looks very similar to the S&P 500. And of course, the Russell's which has been the weakest. It's coming off of a oversold cluster last Thursday, and you got this morning star candlestick formation that formed going into Friday. Well, today it's continued to the upside with this move higher. Again, its near-term line did not quite get into the upper reversal zone. If you take a look at the Bollinger Bands for SPY, you can see we closed right up to about 292 and a third. 292 and a half on a short-term basis is an important level, but you can see how getting above this 290, again, it's important for us to get through there, and really to break through. Once you get through these old high points, which is where the top end of the value area is in the volume profile for the past year, then you've got this vacuum of volume up above and all this volume down beneath that will just suck us up to the upside. So we're also back into the Fibonacci retracement zone of the fans. You take a look at the DMI for SPY, and again, obviously it's bearish when the orange line's above 25 and the blue line's below 20, needless to say. But you see that the blue line is close to crossing up above 20 and being back to being bullish again. They see where you're bullish when the blue line gets above 25, and even more bullish when your orange line gets below 20. So that's still got some room to run, but it's a good sign for the S&P to see that line. So going back to the market forecast chart, again, the expectations when you're on a typical bullish run is for the near-term line to stay above 57 to 12 days. Here, you're kind of starting a new intermediate rally. The last near-term run only lasted a couple of days. So this one, we're currently, we didn't get above, we got barely above 50, so we're 2 days into it. So if we're going to get another, 5 days plus out of that near-term run up above 50, then most likely that means we are going to break above that. And with the idea that it's gotten above 80, and it's gotten well above 80, then there's a good chance that it can make that kind of a run, which would eventually get the near-term line up above 50. And most likely at that point, you would probably have more of like a 12-day move in that range, closer to the 12-day end of the normal spectrum for near-term runs. Near-term runs being defined, of course, when the blue line gets above 50 before it comes back down below 50. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. Also, hit the thumbs up icon down below the video. That tells us, number one, you got something out of the video today. Number two, that you want us to do it again tomorrow. So it's a quick way to give us feedback. If you like the videos and you want us to keep doing it, let us know with one click. And you can do that right now, actually, while you're watching. And also, while you're down there, comment. What did you get out of the video tonight? When the video's over and you're done watching, make a quick comment down below on something you got out of it and why people who come for the first time should check it out. Join our daily Market Outlook email list. Those of you who aren't on our list, there's a link popping out right there on the top right corner of your screen. You can get on our list really easily by subscribing there. Follow me on Twitter for more content in between the videos from day to day. I put a few things out today in regards to the yield curve, so check that out. And finally, join our Market Outlook community that we've created on Facebook. All right, so you can access today's Market Outlook live video that I did at 3:30 Eastern before the market closed by clicking on this link. Again, this is a feature for our Plus subscribers as well as our premium subscribers. Those of you who want to subscribe to our Plus plan, you can also get access to, with a free trial here, you can also get access to my technical analysis class I did last Friday, where I did a little bit of a tutorial on the market forecast, as well as showed you a scan for how to find some stocks using that indicator. And then you'll also get access tomorrow morning live to Brandon's dividend growth investing class. So make sure you check those out. You also get all the archives. Again, just click on that link to subscribe. If you want more information on all of our plans, just go up here to pricing. Down here at the bottom, we also invite you to engage with us on social media. If you click on this little heart that opens up this window, you can like today's Market Outlook tweet from there. If you click on this image, you can like today's Market Outlook Facebook post from there. Again, the more you do that, the more Twitter and Facebook will continue to put our content at the top of your timelines because they see that you're engaging with it, right? So we try to make it as easy as possible for you here on this page. All right, back to the charts, and you can see on the weekly chart with the Hakinyashi candles, we got a pretty decent probability of getting either a bullish candle by the end of the week or a transition candle, which if we do get a transition candle means that we could get a lower shadow, which is a move lower. And I wouldn't be surprised if we do get that move lower. If we are going to be bullish, then that move lower will most likely occur here early in the week, as early as tomorrow, right? Filling, again, back in that gap, as you'll see in a second, to the downside that we gapped up above this morning. So common gaps get filled really quickly. We might be filled in on that gap back down before we do finish the week again. If we finish the week strong with a move to the downside and then a move back to the upside with a higher high point than what we had last week, then you're talking transition candle and now a reversal to the upside. That would be a transition from this week period of bearishness down to the 200-day, and now reversing back up and moving back above the 50-day and working our way back to the upside. That's what this candle looks like, especially coming off of two long lower shadows there. Let's take a look at the 3 green arrow charts. And you can see we got 2 green arrows. We don't have the third one yet. We got to get above the moving average. You can see what those 2 lines look like down here. The stochastics has turned up, has not gotten above its moving average yet. The MACD, the MACD has turned up above its moving average, but you notice it's pretty darn low, and it's really got to get going. When it gets going across 0, it really gets going. It doesn't. It doesn't hedge a little. It makes its run to the upside. Today's move is our first close since the pullback that we've closed above the 17-day moving average. That's usually a pretty decent sign. at least for an intermediate rally, during the intermediate pullbacks. Long-term pullbacks tend to be more bearish, right? But we've talked ad nauseum about how this is more of an intermediate pullback than a market sentiment pullback because of how bearish we were at the beginning. We weren't nearly as bearish here as we were from a volatility perspective over here. So, like we saw back here, a good sign for us to close above that 17-day moving average. We still can get some volatility before we eventually turn higher, but good sign for the markets to start to work their way to the upside. Let's take a look at the intraday chart, and you can see what I'm talking about with that gap. In fact, I tweeted this out here this morning, that this little range that we've had, we moved through so fast. I mean, look, we've been trading in this area for multiple weeks, but this is the lowest area of volume that we have because we gapped down, then we rallied, we filled that gap really sharply within, pretty much within the morning. Then we gapped down through that area again, filled it really sharply the next day on Tuesday, gapped down again, so no volume during the regular trading session, all these gaps. Then we came back up, and now we have gapped up today through that area. So still leaves this little area of volume susceptible for a pullback. It's a vacuum of volume that especially considering that we're at resistance again, that we could come down towards this 288.5, maybe all the way to 270, 287, just under 288, before we meet some support. That would be our lower shadow, right, and then make the run. But if you break up through here, if you break up this above this, pretty much above last week's high point, then there's very, very little volume to the upside until you get back up around to that 300, maybe 297, but up towards that 300 level for the S&P. So you can see why this is such a big battleground, because once the bears do make their way through, then, again, that's the all-time high. That tag over here, 302.25, that's the all-time high. It's still within the last 4 weeks. That would suggest that pretty easy to get back up to it, and eventually, considering coming off of a higher low point, most likely pretty easy to get up through it and make our way towards a new all-time highs. Let's take a look at the volume in the trading range today. Here, let's go to this chart and look at SPY. Again, you can see, consider the gap, right? So we closed at 288.85. The low today was at 291.40, almost about 2.5 points. So we have to add today's range, 2.5 points. We have 1.64, so you're really just over 4 points. So you were almost at the average, a little bit below the average when you include that overnight trading. The volume really dropped off, 53.5 million. So you look at the volume here, that's coming in well below the higher average we have right now. The trading range was also small on an absolute basis, but keep in mind the gap. Again, once you break through, you're going to get smaller moves and smaller volumes. Because usually when you're bullish, right, you're going to bring these lines down, and we're at levels here, a little bit higher in the ATR, even on the average ATR, and actually a little bit higher in the volume too. Very similar levels now that we had back here, which again, leads to the potential for this kind of rally going forward, which essentially is a new intermediate run. Excuse me, wrong chart here. Which would lead basically to a new intermediate run of this green line crossing above 50 and lasting another 1 to 3 months. This lasted a little bit more than a month. The typical time frame is 1 to 3 months, and this would be the third intermediate rally of this current market sentiment run. This coming off of this low point. This was a market sentiment pullback that brought the orange line down. It's called the market sentiment line. So this is the current market sentiment run that we're on, coming off that low, crossing above 50. So we've had 1, 2. This would be the third intermediate rally, and we typically get about 3 to 4, maybe up to 5. We had 5 before, shorter ones at the end, but that's typically, those are really long ones. So we'll see if we don't get another strong intermediate rally here. That depending upon how much of the end of the year it takes in before things start working towards another market sentiment pullback. And you may keep in mind, we get markets and turmoils now on intermediate pullbacks. Imagine what's going to happen when the orange line crosses below 50. It's and it ends up producing. See, the red line is an intermediate market sentiment pullback to where support will be. Imagine had we come down to 2650 or even down to 2700, where there's, obviously some strong support in this area, but the world would have been really in turmoil, that being the case. So at some point in that time, that's going to happen again. According to these technicals, most likely not on this pullback that we're on right now. And you can see from a volatility standpoint, we never did get that surge and close up above 115%, which is what would suggest that we're getting more of a market sentiment decline, and we never did get that. And now we're working our way back down. You see back below 95 where there was some support. Now we're in the neutral zone, and getting above 90 will entrench us now on this new intermediate rally. So we're not there yet, but you can see how obviously we're a lot closer, and we've broken easily back down below 90 and starting to break below to new lows on volatility. It's a good sign, another bullish sign that we are bouncing off of this new intermediate low point. All right, before we look at what's driving the price action and then our trade idea of the day, I do want to take a quick pause, time out here, and just summarize this technical outlook. So, a lot of this, we did have a 6% pullback, similar to what we saw in May and June, coming off of a 10% rally, not quite the same rally on the previous intermediate pullback, but still a 10% run in the middle of the year over the course of a month and a half is still a pretty decent move in that short amount of time, hence the 6% decline. That got down to the 62% retracement level, found some support, and so far the last couple of trading sessions are bouncing. We haven't completely bounced, right? The intermediate run is now not entrenched yet, but it's the signs are looking better and better for that to be the case. Not without maybe some volatility as early as tomorrow, but by the end of the week, we could have a nice, good either bullish candle or transition candle, leading towards more bullish candles on our weekly chart, on our Hakinashi weekly chart. So. Good signs ahead, good opportunity, good odds for a new intermediate run to begin, which could last a month or two or up to 3 or more. We don't want to go too far above 3. That usually leads to a really uncomfortable pullbacks, like we saw, say, back in February of 2018, where we had a 5-month intermediate rally. Way too long, right? So we like to see, get up to 3 months, 2 to 3 months. And considering that we've been on a pretty decent market sentiment run for most of the year with these 2 short little pullbacks, and the average 5% pullback or so, we get a couple of those a year, and we've gotten 2 this year. So we'll see what kind of run we get into the end of the year, and we might not even get another intermediate pullback. If we can go another, what would that be? 4 plus months into the end of the year. Most likely going to get something before December, and then we head into 2020. So that's what we're seeing right now. What do you think? Do you agree or disagree with that assessment? There's a link popping out right there with a poll. As always, if you agree, click agree. If you disagree, which is fine, click disagree. But what I do say is if you click disagree, comment down below with what you're seeing, right? Everybody's got their opinions on what the market's going to do, but what drives your opinion? If you disagree that maybe you're more bearish, or maybe you're already really more bullish than I am, what drives that opinion? What kind of charts or indicators are you seeing that would suggest that? Obviously, there's a lot of stuff out there, and I'd love to share that with the rest of our market scholars crowd. All right, well, let's talk about now what's driving the price action today. It was a continuation, and all eyes are kind of on what's going on with the Jackson Hole and the expectations of a Fed rate cuts coming here later in September at the next meeting. So everybody's going to be kind of watching to see what their tone is with the things that they say. You can see crude oil was the main driver today, and as it usually is the case, it's kind of your higher beta move. But look at the gold and TLT. So those have been the trades, right? The bond yields and gold have really made just dramatic moves to the upside, parabolic moves in the case of like gold here, making and in fact from a linear regression standpoint, just really getting sharply to the upside. Well, in the last couple of days now, and this is today's right here, pulling back from those levels and pulling back into its, towards its linear regression, the trend line that runs across the middle. And you could say the same thing with TNX. TNX having closed below the third standard deviation channel, bouncing back up and getting back in, and a little bit of a kind of a divergence setting up here with this lower low point, higher lows on these oscillators. You can see the big move to the downside on the CCI, and usually when you have such a sharp move like below 250, it usually diverges after that. So you had a continued move to the downside, and you got another drop here below minus 100, and now it's working its way back up. So there's opportunity, and of course, looking at the MACD and the stochastics for TNX, again, you can see how this move that we got basically has just gotten us up to the 8-day exponential moving average. But look how low the MACD is. You put that in the context, say in the past 5 years, and that's about as low as the MACD has ever been, at least has been in the last 5 years. The other period of time being this bearish was 2016, and of course diverging here by the summer of 2016. Now, I did want to point this out, so I tweeted this out earlier. One reason for this yield curve inversion that we're not quite at yet. You can see how we've gotten close to zero. But if you look at like previous yield curve inversions, here's the most these are the two yield curve inversions that preceded the last two recessions / bear markets in the stock market. We had the inversion right here, but you can see that the short-term yields were all rising all the way up to the end of 2005, beginning of 2006. We had a little bit of a decline in long terms, but not nearly as much of a decline as what we're seeing right now. And in 2000, here's where the yield curve inverted right at the very beginning of 2000. You can see yields were rising up to that point to get there. Even long-term yields were rising. It's just that short-term yields were rising faster. And we got our inversion at the end of January that year. Well, this is what we look like now, right? So we don't have anything rising now. I mean, they're all falling sharply. In fact, the 10-year has really come down since the end of 2018. And part of the reason why is because of this, right? This is the spread between the U.S. Treasury yield and the German Bund yield for the 10 years. Same time frame, same 10 years. You can see that, here's back all the way to 1999 here, very, very end of 1999. So, here's our recession, how you can see how it comes down. In fact, it came down here in mid of 06 after the Fed stopped raising interest rates, right? The Fed stopped raising rates in the summer of 06, and then the spread between the U.S. and German Bund started to fall. Remember, the Fed didn't start cutting rates until 2000. So that's 2007. That's when the Fed cut rates, and by then, the spread between the U.S. and the German Bund was negative. Obviously, we went into recession there, and the worst part of our recession over here when it was negative. We're not anywhere close to this spread being negative, and the Fed has already started to cut rates. And look how high. I mean, we were 280 basis points difference at in that November timeframe when the 10-year note peaked. So this is why the 10-year note's falling so much, and for that matter, which is causing the Fed to also lower rates, and why you see the administration saying that the Fed needs to lower by a lot more, because even then we're still 225 basis points above where the German Bund is, with the Fed cutting rates. Usually the Fed cutting rates is, we're pretty darn close to being even with the German Bund. So that's a pretty large magnet drawing this yield lower, as low as it has been. And again, with the German yields negative, that's why we have 160 basis point for us, but it's still 225 total because theirs is about 60 basis points negative. That's a big driver, but we've had such an extreme move, and I've shown you this chart. I'll show it to you again here. Excuse me. The rate of change for the 10-year note, and going back those 200 days. If I were to go back to 200 days, again, 200-day moving average, right, which actually coincides. That's pretty close to where we peaked there. But if I hit OK and hit OK here, again, we've lost about half. The TNX has been cut in half over a 200-day time frame, and that's not a common occurrence. And again, the last time we were this low was back over here in the credit crisis. We were pretty darn low there too in 2011. And just again, a reminder on the, here's where the German Bund and the U.S. Treasury yield were in the credit crisis. I mean, they were pretty much lockstep with each other. So again, that kind of shows things are a lot different this time from a yield perspective because of that gap, which is as big as it's ever been. Right, you go back to 99 and the 90s and before. This is about as big of a spread as we've ever had to get up to the 260 basis point area, plus or minus a little bit. In fact, the last time we were this high was actually in the late 90s. We were this high here. If you look at the dollar index during that time frame, the dollar index was extremely bullish. If I go out to, let's just go to max available, and we'll go to a monthly chart. Here in 99, 2000, all the way up to 2002, but look at where we were in 2000. We were up 105. We were all the way up to 100. We peaked at 120 on the dollar index, because again, and people were, that spread was so wide that they were soaking up all these U.S. Treasuries because their yields were so much more, and they were able to get more for that. Well, you can see the possibility of that occurring here again with the dollar index, but again, not nearly, relatively bullish, relatively similar areas. Again, go back to 2011 where we were during the last time the yield had fallen this far. The dollar was a lot more, was a lot less bullish, was at one of its lowest levels. Again, the yield's falling so precipitously means that people are buying bonds in droves, and so it's usually bullish for, you see that they're buying. A lot of foreign investors have to exchange their currency and buy dollars for that. The dollar really kind of took off from that point, and you can see we saw that back here as well during that recession. And could we get another move? We break up above 100 and really work our way up. There's potential for the dollar to take off as well, strongly to the upside. That would be really, really positive thing for U.S. stocks, which have already been just absolutely outperforming significantly their international counterparts since this low point in 2018. You shouldn't be surprised to see energy stocks up here finally. They've been such an underperformer, but they rallied more than 2% today on that jump higher in crude oil. But you also have, tech stocks, big names, big cyclical momentum type names, technology, communication services, discretionary, all leading the way higher. All the rest of the markets lagging behind, including the safe havens. That's not surprising either. You would expect on a risk-on day for safe havens to outperform. In fact, your two interest rate sensitive areas still rallied, just didn't rally nearly as much. If you take a look at the sector rotation here, give me 1 second to bring this up. Here's their charts, all the different charts that they have. You can see our biggest winners were our real estate utilities and staples. They're all at the 3-month highs. They all have really strong, minus staples here, but the real estate and utilities showing overbought clusters Friday. They continue their rise up today. Everything else is trying to come off their lows, as you can see, all very similar to the S&P 500. Healthcare is still below its moving average. Technology, they're still below 50. Same thing with industrial. Same thing with discretionary. Same thing for that matter for materials. Financials has been struggling with the low yields. They've had a couple really good days, but still, below 20 on the intermediate line. Same thing with energy. Those have been the two real biggest losers, which means they have a lot to gain if yields do make a rally and commodity prices rally too. They've been underperformers for so long. Their margin of safety is much higher. Their reward to risk potential is much higher, considering. And whereas some of these other areas have less reward with more risk, considering how bullish they've already been during most of this period, and that would include especially these interest rate sensitive areas and utilities and real estate. All right, one of the stocks in that cyclical space is Nvidia. Nvidia is our trade idea of the day, and for those watching on the live Market Outlook Live, we put our trade in before the market closed, which is one of the benefits of watching that video. So make sure you tune in to that. Remember, I showed you how to do that before and how to subscribe to that. But it's had a nice good run here with a break back up above its moving average. It's got a green line. The green line that's moving, the moving average it's got green shading. It's light green shading with the intermediate line turning higher. The moving average has turned up, so you'll get a green line tomorrow on the moving average, and that's a good sign. That's the combination you want to see. Good, coming off an overbought cluster right before on the day of its earnings announcement, and then the 2-day rally. Very, very good opportunities here. You look at the 3 green arrow chart for Nvidia, and you see what stands out is you got 3 green arrows with a jump in volume. You didn't have that Friday because none of them had 3 green arrows, but today you got all 3 green arrows with a jump in volume. That usually leads to a pretty good move to the upside. Of course, market posture needs to coincide with that, generally speaking, but that's a good sign. It's a good trend trading signal to get 3 green arrows and a jump in volume on a sideways trend like that. If you take a look at the long-term moving averages for Nvidia, you can see how we've been basing here, and the momentum has been gradually moving to the upside, kind of looking for this breakout to occur, and we'll see if that breakout ends up happening. If you look at the DMI would suggest with this that we are close to getting that, with the blue line jumping sharply again back above 25, and then the orange line almost back below 20. That's the bullish combination you like to see. The Bollinger Bands didn't quite get outside the upper Bollinger Band, and that's because the band width is relatively high. You see, though, that we broke back above this big volume node, and not nearly as much volume above where we're at now. A lot more to the downside. So you got good, again, reward risk ratio, right? You got little risk because you got such good strong support here. You got a lot of reward potential depending upon the type of trade you do. Expensive stock, so depending upon whether you want to buy the stock, it will take a lot of capital to buy it, depending upon how many shares you end up getting. But you can also look to do a vertical spread trade. I'm looking out here towards October, a little bit longer time frame, going out to the 180 level price. You can see from a risk profile perspective, one standard deviation move on Nvidia out to October expiration will easily get you through up to $197. October 19th expiration there. Here, let me do the slice of the break even here. So a move up to 180 would be really easy for it to make that kind of move. And then you see, okay, well, we sell the 180, buy the 175. We need to close above it 180 for us to get the return on that. And if you look at the return here, let's set this up again. You can see it costs a couple $100. We'll put $100 of that at risk, right? So we'll get out of this trade with half of the maximum loss, which is the cost of that spread, and then we'll go for the other $300. $300, and then we'll cover, as you saw, I did a short put trade on that as well. We'll cover the cost of that with the $286 put, and that requires $1,500 in capital. So to make this trade, we'll need $1,500 plus the $200 for the vertical spread, and the potential reward will end up being, if we do get above 180, about $1,100 and would be $1,149 if both trades work out there. The short put works out for the 279. Sorry, half of that. It was 574. So I had the other trade on there. The 279 plus the $300. So you get about that 570 some odd dollars. Your maximum reward on the $1,500 margin requirement. Covering most of that, covering the short put, where all the way down to 150, and you can see again you have very, very strong support above 150. So the odds are relatively low that you'll close down there to begin with. But really that number is probably a lot higher than 80 because of the strong support level that we know is there with all that volume. And you can see how all the way, because that put, I got more credit, I've got little risk to the downside until I break 150. If we stay down here for whatever reason, then at least I covered with that short put, I've covered almost all of the maximum loss on that vertical spread. In fact, I have covered, I've covered the maximum loss on that vertical spread all the way down to 150. All right, so that wraps us up for today. Now I want to hear from you. Use that link right there popping out in the top right corner of your screen. That takes you to our Market Outlook forums on marketscholars.com. Open up any new thread that you have with any questions or comments on anything we discussed in the video today or anything we didn't discuss that pertains to this topic, of your market posture and this trade that we're looking at. So again, thank you for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video. Also, follow me on Twitter for more content in between the videos from day to day, and join our community at marketscholars.com, as well as the one we created on Facebook, as I showed you before. Have a great rest of your evening, everybody, and we'll see you all tomorrow.